everyone. I'm David Darst here to give you a recap of the third quarter of 2024. Certainly some interesting developments in this quarter. You had in the economic department varying growth rates. The United States moderating and the outlook for 2024 wrap up and into 2025. You're looking at around 2.6% this year, maybe 1.9% next year. Europe, a much slower rate of growth. This year, maybe less than 1%. Next year, 1.5%. And of course, China, around 4.5% to 5% as they are implementing some stimulus measures that they started late in the quarter, as you know, and they've been adding to them. Inflation continues to slow, but at a much slower pace of slowing. In Europe, inflation has bounced around a little bit. And in China, you're basically looking at the export of deflation as they step up their export activity in response to sluggish economic growth domestically. They have continued to export goods, which is putting downward pressure on prices globally. The case that we're working with right now is the base case would be for a soft landing. That's where inflation comes down, economic growth slows but does not retrench into an actual decline, a couple of quarters decline. We could get close to that, but our base case is for a soft landing. Inflation down, economic growth slows but does not tip over into a recession. That, I would emphasize, is possible. That's just the base case assumption. It could be better than that, could be more disappointing than that. The monetary action of the Federal Reserve late in the quarter, September 17th, 18th, at the meeting, they cut by 50 basis points. And Chair Powell, after the meeting and subsequently, has said he did not want to get behind the curve, meaning that the economy begins to drop off too quickly. And therefore, he's got to step up the pace of monetary policy reductions. The Fed easing, basically, as you enter the fourth quarter, there's some debate over whether they'll do another 50 basis points, another 75 basis points, or maybe even nothing. So that remains open. That's the essence of the message from the monetary policy authorities. These monetary flows, basically the lower of short-term policy interest rates, has led the beginning of investor flows further out the risk spectrum. So you're beginning to see money move out of Treasury bills, out of short-term liquidity instruments into more risk assets. Not necessarily risky assets, but risk assets. Now, we emphasize during a process like this an extra degree of vigilance, of discernment, discrimination, discipline, and selectivity. That's the key word, selectivity, as you move further out the risk spectrum. Now, during the quarter, there were some interesting, I wouldn't call them reversals, but certainly maybe the beginning of new trends. You had value. The Russell 1000 value grew by 8.6%, whereas the Russell 1000 growth grew by only 2.50%. With interest rates coming down, of course, you had high grade and high yield bonds. High yield bonds yielded 5.45% during the quarter. High grade bonds, 6.90% during the quarter, as rates fell even more in that segment of the capital markets than in the high yield. The S&P 500 rose 5.06%, and the Tadawul index 4.52%, and of course FANG. This is your Alphabet, Amazon, Netflix, Google, and Facebook, which is now Meta, the FANG group. They were up only 3.58%. Part of this underperformance of growth relative to value. The utilities. This is a group that's really it's interest rate. They're almost like bond substitutes in some ways. And during the quarter, they were up 13%. The utility, S&P's utility sector, 13%. The financials, they tend to do well when you're getting a movement towards a more positively sloped yield curve. We've had a couple of years where short-term interest rates were above intermediate and longer-term interest rates. Now we're flipping over to an actual positively sloped yield curve where short-term rates are below long-term rates, and that's deemed or thought to be positive for the banks, the financials, and they did well during the quarter. They were up 8%, and this Magnificent Seven, and this includes, of course, NVIDIA. It includes the FANG stocks I just mentioned, Apple, Amazon, Netflix, Tesla. Okay, you have that group was up barely less than 1%. It was essentially flat for the quarter. Our thought here in this kind of environment is in an asset allocation. You want to basically be favoring credit over equities. Equities are very fully valued here in terms of the S&P. The major indices have come up in value as a whole. We also have been saying the 60-40. This is the classic 60% equities, 40% bonds or interest rate driven asset classes. We think this is a continuation of the time to really open up the portfolio to volatility dampening and in return enhancing asset categories, asset classes. And here we come to alternatives. We seek alternatives primarily where the managers can identify dislocations and basically look for positive risk premiums where you're getting paid for a little bit of illiquidity. You're getting paid for a position in the credit structure that is rewarding. So that's our emphasis for the in the alternative space: credit over equity, and within credit, some blend of liquid credit. There you're talking about high yield. There you're talking about collateralized loan obligations. That asset category, that asset class is really showing some further expansion as investors seek this. You really are looking for, in the high yield space and in the levered loan space, in the collateralized loan obligation space, you're looking for managers who can identify and to capture that extra return that these categories within credit are offering. The credit risk, we want to be as sensitive to credit risk. We want to select managers who are basically capturing a seniority in the credit structure and also covenant protection. That's where the investor has protections, and that basically we think gives an added layer of protection. In private equity, our feeling there is continued secondaries, where secondary limited partners and general partners both are looking to have private. There's a sale of private equity interests, and that leads to, we think, very interesting and attractive opportunities in the private equity space. Let us wrap up. We're closing in on the election in the United States. As of now, the two candidates seem to be neck and neck. Different polls are showing basically that this is probably going to come down to about 7 states, and within those 7 states, particularly 2, and that would be the state of Pennsylvania and the state of Georgia. We will see how the election turns out, and we look forward very much to visiting with you very soon. Thank you for being with us today.